For the fourth time this year, the Federal Reserve has raised its benchmark interest rate. The central bank made the decision to hike up the rate 3/4 of a percentage point. The move is an effort to drive down inflation, which hit an annual rate of 9.1% last month, the highest level in 41 years.
We know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most.
Well, interest rates are a blunt instrument for the Fed. The idea, make it more expensive to borrow money, and that means that people buy less, and in turn, prices cool off and inflation drops. This latest rate increase comes at a time when Americans are paying more for just about everything, including new homes, rent, cars, and food. For more, I want to bring in Megan Cassella. She is a reporter for the investing publication Barron. Megan, are we seeing any concrete signs that these interest rate increases are not only slowing down inflation, but are also improving the economy?
They're improving the economy by having a little bit of the impact that the Fed wants them to have. They're slowing things down. It can be bad in the short term. It means that people are spending less. It means that, some employers are not looking to hire if they were beforehand. Businesses might be investing less. The housing market is cooling off. So it doesn't sound like good things on their face, but what the Fed is trying to do is slow the economy. So they're having an impact, certainly.
Well, there could potentially be another hike in September. How might that compare to what we just saw?
Fed Chair Jerome Powell today really didn't want to give too many clues about what was coming. We can be pretty confident, of course, that a hike is coming, but he sort of said dispense with the forward guidance. There's a lot of time between now and then. There's a lot of data to come between now and then. The Fed is really wary of doing too much too fast. They know they've just had two back-to-back 3/4 point increases. That's a huge amount of tightening in a short amount of time. And they want to give it some time to ripple through the economy. He didn't completely rule out the possibility of another 75 basis point hike in September, but he also said it's possible that something smaller could be coming. And I think we can be pretty confident as well that they will signal what they're thinking once we get closer to that meeting.
Yeah, it was interesting to hear Powell's remarks, especially since we had so much signaling ahead of this one. I also want to ask you, of course, because some economists worry that interest rate hikes could trigger a recession. You alluded to that as well, with people slowing down their buying, companies maybe not hiring as much. Explain more about how that would happen, and really how concerned are you about that?
It's a really fine line between slowing the economy just enough to bring down inflation and not so much that it triggers widespread unemployment, mass layoffs, that sort of thing. And so, it is a concern. It's a growing concern. A lot of economists have it about 40 or 50% chance that a recession is coming, probably not this year, but early next year or sometime in 2023. The expectation is that it would be shallow, which means it wouldn't be that painful. But we are seeing signs, like I mentioned, people are slowing down their spending. Businesses aren't investing quite so much. If we do start to see, we've seen some anecdotal layoffs, especially among tech companies or in the housing sector so far. If we see those start to spread, that becomes a little bit worrying. And one of the biggest signs right now, or one of the biggest signals that economists are really worried about, is the widespread expectation that a recession is coming, because it can start to be a little bit self-fulfilling. It's not unfounded. There's a lot of reasons why people are scared right now. And the more that they act like it, the more that they start to shift to buying brand name products, or away from buying brand name products, and they start to, not buy that TV or that couch or that car that they were thinking about, then that slows the economy. And if that happens en masse, if a lot of people start doing that at once, if businesses start acting the same way as well, that's when things could really start to slow, and the fear sort of starts this recessionary cycle.
Yeah. So obviously we've been talking a lot about how people will be paying more for new home mortgages, car loans because of this news. For our viewers wondering how this affects their family's finances, are there any direct benefits to the Fed raising interest rates?
It's a hard argument to make, of course. What are the benefits of really high inflation, of the Fed moving to rein it in when so often those actions end in recession. But there are some. I mean, if you have money in a high yield savings account, you might start to see increased returns as those interest rates start to go up. That could be a good thing. If you have some significant loans with a fixed interest rate, if you have student loans or if you have a fixed rate mortgage, you're paying that debt back with money that's now less valuable than it was when you borrowed it. That can be a good thing if it's a significant sum of money. And I think what the Fed would say too is just, it is painful right now. They are the first ones to acknowledge it, but that it's worth it to pay a little bit more now to see these interest rates go up now in order to try to avoid a larger, deeper recession. That's really what they're working towards. They really believe that, in the short term, the pain is worth trying to avoid a long-term depression or a long-term recession. And so that's what they're working towards right now.
All right, Megan Cassella, thank you so much.
Thanks for having me.